Are you a small business owner wondering whether a company car is a good idea? Maybe you're not sure about how the tax on a company car actually works and how to save yourself a lot of money. In this video, I'll break it all down for you using real-world examples and advice. How company cars are taxed, why electric vehicles are gaining popularity, and also when a van might actually be a smarter choice. First, what does a company car actually mean? Well, a company car is a vehicle provided by your company for either business or personal use, or a mix of both. To explain simply, you would buy or finance the vehicle in the name of your company and pay for it from the company bank account. This makes it a business asset. And as a business asset, the company can offset the cost of the car, the insurance, maintenance, and even repairs if it's not a leased vehicle, reducing the company tax bill. The insurance should be through the company, although the logbook can be in the name of the registered keeper, which is the driver of the vehicle. As a business owner, you might provide a car to yourself, an employee, or both. It's an attractive perk, but it does come with tax implications, which we'll get into shortly. Before that though, I wanted to share some ways that my clients use their cars. Angela, for example, has a small consulting firm. She uses her company car to get to and from client meetings. Rob is a carpenter and uses his van, quite obviously I suppose, to transport his tools, his equipment, his materials to wherever he's working that day. Jax has an IT support company and she provides her two staff and herself with cars so they can go to on-site call-outs to fix client problems. Now, how are these company cars taxed and what will it cost? Well, I'll get to the actual cost shortly, but in the UK, company cars are taxed on individuals through benefit in kind, or BIK for short, which applies if the car is also used for personal use. The tax is calculated based on 1. The vehicle's P11D value. Now that's its list price, not what you paid for it. It includes VAT but excludes any discounts. The term list price also refers to the original or the recommended retail price of a car as set by the manufacturer. Then 2, its CO2 emissions. And I've included a link to HMRC's CO2 emissions calculator in the description below. And then number 3, it's the BIK rate, which is set by HMRC and depends on the vehicle's emissions and fuel type. And here's a couple of examples. So if we look at a petrol car like a Nissan Qashqai 1.3 DIGT petrol model, the CO2 emissions are 142 grams per kilometre. For the 24-25 tax year, this falls into a benefit in kind rate of 33%. If the car's P11D value is $30,000, a higher rate taxpayer at 40% would pay $3,960 per year in tax. Let's take a hybrid vehicle. The Nissan Qashqai e-Power is an electric hybrid. Now that emits just 19 grams per kilometre of CO2. Its benefit in kind rate is only 8% for the same period, 24-25. For a P11D value of $34,000, the same taxpayer pays only $1,088 annually in tax. That's a dramatic saving of nearly $3,000 a year. But an important note though is the BIK will be the same every year for your chosen vehicle. It doesn't drop in line with depreciation on the car, and that's usually why you see company car owners switching their cars every 3 years. Why not if you're going to pay the full price anyway? But later I'll show you a table that sets out what a company car will actually cost you. So let's first quickly talk about the benefits of choosing electric over petrol or diesel. Why consider electric vehicles? Fully electric vehicles offer massive tax advantages and they're becoming increasingly practical for business use. Some of the key benefits are the low BIK rates. Fully electric cars are taxed at just 2% of their P11D value for the 24-25 tax year. And then there's capital allowances, so businesses can claim 100% first year allowance on the cost of new and unused electric cars. Now that significantly reduces your taxable profits. And then running costs. Electric vehicles have lower fuel and maintenance costs compared to petrol or diesel cars. For example, John runs a property management company and has a Tesla Model 3. Now he uses it to get to inspections, site visits, as well as meeting clients, etc. It has a P11D value of 42,000 and a BIC rate of just 2%. John's a high rate taxpayer and it costs him just £336 annually in tax, a fraction of what a petrol car would cost. Should you consider a van instead of a car? If your business needs practicality over style, a van might be the better choice. If your personal use of the van is incidental, then there would be no benefit in kind. Vans have a simpler tax treatment. They have a flat BIC charge of $3,960 for the 24-25 tax year. And if the van's electric, the BIC charge drops to £720. For example, Dan, who's a plumber, he went for a Ford Transit Custom plug-in hybrid as it's got a flat rate electric van BIC rate of £720. And he told me he chose it for the space as well as much as the low cost. Additionally, electric vans qualify for government incentives like the plug-in van grant, and that offers up to $8,000 off the cost of a new electric van. So let's summarise the costs with a direct comparison. This table shows how choosing an electric vehicle or van can dramatically lower your personal tax bill. So whether you opt for an electric car, a hybrid, a practical van, or stick with traditional vehicles, understanding the tax implications is essential. If you found this video helpful, hit the like button and subscribe for more insights on tax and business tips. Catch you next week.